Junk bonds are a type of corporate bond that offer high returns but come with higher risks. They are issued by companies with lower credit ratings, meaning there's a greater chance the issuer might default on their debt. Investors are compensated for this risk with higher interest rates compared to investment-grade bonds. What are junk bonds? Bonds are loans that investors provide to companies or governments in exchange for regular interest payments and the return of the principal at maturity. Junk bonds, also called high-yield bonds, are issued by companies with poor credit ratings, rated below BBB by S&P or by Moody's. These companies typically have financial challenges or operate in volatile industries. Key features of junk bonds. High yield. Junk bonds offer significantly higher interest rates compared to safer bonds, like U.S. Treasuries, to compensate for the increased risk. Low credit rating. Issued by companies rated BB+ or lower by S&P or by 1 or lower by Moody's. Risk of default. There's a higher chance the issuer may fail to meet interest payments or repay the principal. Why invest in junk bonds? Higher returns. Junk bonds can provide attractive yields for investors willing to take on more risk. Portfolio diversification. Adding high-yield bonds to a portfolio can offer higher returns, especially in a low-interest rate environment. Potential for price appreciation. If the issuing company's financial situation improves, the bond's value can increase. Risks of junk bonds. Credit risk. Higher likelihood of default, meaning the issuer might not repay the bond. Market volatility. Prices of junk bonds are more sensitive to economic changes and market sentiment. Liquidity risk. Junk bonds may be harder to sell quickly without a loss. Example of junk bonds in action. Imagine a startup with a credit rating of B+ wants to raise $10 million. Due to its higher risk, it offers a 10% annual interest rate, compared to 3% for a highly rated corporation. An investor buys $1,000 of these bonds and receives $100 annually in interest. If the company grows and improves its credit rating, the bond's value could rise, providing additional returns. Junk bonds versus investment-grade bonds. Junk bonds, higher yields, higher risk, lower credit ratings. Investment-grade bonds, lower yields, lower risk, higher credit ratings. Quick recap. What are they? Junk bonds are high-yield corporate bonds issued by companies with low credit ratings. Why invest? They offer higher returns, but come with increased risk of default. Risks and rewards. While junk bonds can enhance portfolio returns, they're more volatile and carry greater credit risk. Junk bonds can be a lucrative investment for those who understand the risks and seek higher yields in exchange for greater uncertainty. Always research and assess your risk tolerance before diving in.